With stocks up so much already this year, I understand your worry about underperforming the rest of the year.
But it does make me happy to see that you're getting something in a money market account at 5% versus getting nothing holding in cash. So good job on that.
Back to your question, I would say there's two ways to avoid underperforming the market.
The first one is avoiding market timing at all. So dollar cost averaging into something like an index ETF.
For example, VU. So you buy at the peak, but you also buy in the dips. So on average, you're going to match the returns of the overall market.
Well, that's not as sexy. You still get good returns over the long term.
The second approach to look at short-term performance and trying to outperform is looking at something like the business cycle and trying to predict what stocks will do well over the next 6 to 12 months based on where we're at. This Fidelity research shows that we are currently in the late cycle, headed towards a recession.
I personally believe the stock market tends to front run cycles. So when we're in the late cycle, it's really about stocks that are in further cycles that will do well.
And based on the sectors that have recently been doing well, we've skipped the recession. So even if it happens, it's like, who cares? Because it seems like we're currently focused on the rebound already. In terms of squeezing outperformance in the short term, I think stuff like technology, industrials, materials, real estate will still perform pretty well and still have some upside.
If you're talking around 6 months, the longer term you're talking about, that's where chasing can sometimes hurt you.
That's why I personally like to have a portfolio full of different sectors and focus on individual stocks that show upside relative to their current value.
The first option is a lot more passive and easier to follow for the general public. Now, if you're really into active investing, yes, you can get outperformance of the market, but it definitely requires you to be a little bit more nimble and follow the business cycles and also follow valuation. Hopefully that gives you some ideas.